Here are a couple of growth and income stocks that you may want to consider for your review. As posted, tracked out, and researched by Todd Bunton, our growth and income stock strategist here at Zacks.com. So you've got an insurance company and a REIT.
Yep.
Marsh and McLennan is the insurance company. Have you talked about this one before?
You know, I might have, because they've been a very steady operator, which I'll get to in a second.
And you're big on insurance companies.
Yeah, and not so much brokers. These guys are the world's largest insurance broker.
Yeah.
And I've talked more about property and casualty insurers, a company that actually underwrites the insurance. But I found these guys through a screen and researched them. I love them. They're pretty global too. About 55% of their revenues come from outside the U.S. Like I said, they're the world's largest insurance brokerage. But that risk and insurance is only about 54% of their business. They also have a consulting side that's about 46% of their business. So some good diversified revenue streams, and that's actually helped them deliver very steady operating results over the last few years, really. If you go back to 2011, the company has met or exceeded the Zacks consensus estimate every single quarter.
Wow. So
very solid earnings momentum here, and that was on display in the last quarter, where they saw solid organic operating revenues and solid profit margin expansion, and that drove double-digit bottom line increases in earnings. So if you look, analysts expect that to continue over the next actually a couple of years, and I brought with me the agreement and magnitude of consensus estimates as well.
That's what I wanted to hear.
Yeah, you can see after the last beat, analysts almost unanimously raised their estimates for both 2014 and 15, and the magnitude of that increase was pretty significant. And that sent it to a Zacks rank of 2, which is a buy rating. But based on those consensus estimates you see, analysts expect about 13% earnings growth this year and 12% growth next year. So good low double-digit growth story here. Again, a lot of that's driven by good increases in organic revenue. Last quarter, they saw mid-single-digit organic revenue throughout almost all of their businesses, and through cost containment, they were able to expand their profit margins in the process. So you've got a good growth story here as long as the economy continues to improve. Like I said, they're pretty global. They do have a heavy presence in Europe too, but that's actually been starting to become a tailwind for them as the economy picks up there. And all that, you also get a solid dividend that yields 2%. And the company has actually increased that for 4 consecutive years. So, and their payout ratio is relatively low too. So as long as they can continue to grow earnings, I'd expect that dividend to continue to march higher. So you've got growth, you've got income, all at a fair price. They trade about 17 times forward earnings. Not a screaming value, but that's in line with its peers. So so I'd say you're getting a lot of stability, solid earnings momentum here, good growth and good income at a pretty reasonable price. So I'd expect solid total return potential from this name over the next 6 to 12 months.
I missed that growth and income. I mean that magnitude and whatever when you don't do it. Just letting you know.
Okay.
All right, the jury's out. There's some debate on how to pronounce this name, Sovran or Sovran. Self-storage.
I'm not sure. I've only read it myself, but yeah, they're one of the top 5 largest self-storage REITs in the U.S. They operate 484 self-storage facilities in 25 states under the Uncle Bob Self-Storage name.
Oh, Uncle Bob.
Yeah, which they have a pretty big presence in Texas, Florida. Like I said, they're in 25 states.
Kind of folksy.
Yeah, right. But they've delivered 3 consecutive positive earnings surprises, including a solid beat back on February 25th. And they're seeing solid increases in rental rates and occupancy rates. And I've noticed that throughout the self-storage space. It's been a very steady operator over the last several years. So they've got good earnings momentum. I brought with me here the price and consensus chart, which is another one of my favorite charts. But you can see a solid increase in consensus estimates over the last several months, and a nice upward slope in both 2014 and 2015 consensus estimates. That's why it's a Zacks rank of 2, which is a buy rating. And based on consensus estimates, analysts expect about 13% funds from operation growth this year, 9% growth next year. So good growth. Obviously, as a REIT, they have to pay a good dividend. The law there is they have to pay out 90% of their earnings in the form of dividends to avoid paying tax on that money. So they pay a dividend that yields 3.7%. So very solid income to go along with good growth here. And they actually increased that by 28% earlier this year. And they've actually increased it 3 out of the last 4 quarters. So very shareholder friendly. and all at a pretty reasonable price. They too trade at 17 times forward earnings, but that's in line with its peers as well. And if you take a look at the price and consensus chart again, you can see price came down pretty significantly last year, and that was nothing company specific. That was only because of the fact that they have a solid dividend yield. And when people started talking about the taper, they sold off REITs like this. But you can see a nice solid rebound this year, and I think you're seeing that in REITs in general. So could be a good buying opportunity here. Good solid total return potential in 2014 as well.
Maybe they should have just called the company Uncle Bob's Self Storage.
I don't know why they
that
didn't.
whole
Yeah.
pronunciation problem, wouldn't it?
That's easy enough.
Do you own either of these?
I do not.
All right, check out other stock picks and stock picking strategies on our website, Zacks.com, if you're not there already, with Todd. I'm Terry Ruffalo.